What if I told you that everything you think you know about money is already obsolete? Not in 50 years, not in 20, right now, today, as you're watching this video. Here's the thing, the banking system we all grew up with, the one your parents trusted, your grandparents built their lives around, that system took over 100 years to become what it is today. 100 years of lobbying, legislation, infrastructure, and slow, grinding institutional power. Crypto is doing the same thing in 10 years. And most people have absolutely no idea this is happening. They're still arguing about whether Bitcoin is real money. They're still laughing at NFTs. They're still asking, but what is it actually backed by? While trillion-dollar institutions are quietly moving their entire financial infrastructure onto the blockchain. This isn't a prediction. This isn't hopium. This is pattern recognition. And once you see the pattern, you can't unsee it. So today, we're going to break down exactly how crypto is compressing 100 years of financial evolution into a single decade. We're going to look at the 5 massive parallels between what banks did across the last century and what crypto is doing right now. And by the end of this video, you're going to understand why the next 2 to 3 years might be the most important financial window of your entire lifetime. Stay with me, because this is going to change how you see everything.
Section 1. The banking system didn't start with trust. It earned it. Let's go back. Way back. The year is 1910. You're a farmer in rural America, or a factory worker in London, or a merchant in Shanghai. And here's the question your great-great-grandfather was asking himself every single day. Should I trust the bank? Because back then, banks weren't trusted. They weren't respected. They weren't even fully understood. The average person kept their money under their mattress. They traded in physical gold and silver. The idea of handing your life savings to some institution and trusting that it would be there when you came back, that was terrifying. Sound familiar? Because that's exactly what people are saying about crypto right now. I don't trust it. I don't understand it. What if it just disappears? Here's what history tells us. The banking system spent the first 30 years of the 20th century just convincing people it was legitimate. The Federal Reserve was created in 1913. The FDIC, the thing that insures your bank deposits, wasn't created until 1933. That's 20 years just to establish basic trust infrastructure. Before the FDIC, bank runs were a normal part of life. People would panic, rush to the bank, demand their money back, and banks would collapse overnight. Sound familiar? Because we watched the exact same thing happen with crypto exchanges. FTX, Celsius, Voyager, BlockFi. The pattern is identical. It's just happening at 1/10 the speed. And here's the critical thing that most crypto critics completely miss. Those banking collapses in the 1920s and 1930s didn't kill banking. They forced the creation of better systems. The FDIC, deposit insurance, banking regulations that actually protected consumers. The FTX collapse didn't kill crypto. It's forcing the creation of better systems. Proof of reserves, decentralized custody, on-chain transparency that makes every transaction auditable in real time. Something traditional banks still cannot offer after 100 years of trying. When banks failed in 1929, governments didn't ban money. They built better financial infrastructure. When crypto exchanges failed in 2022, the response should not have been, "I told you so." It should have been, "Watch what comes next." Because what comes next is always the same thing. Standards, infrastructure, legitimacy. And we are watching that happen in real time. Section 2. Crypto just cracked the code that banks took 50 years to figure out. Here's a number that should stop you cold. 1.4 billion. That's how many people on this planet right now have no access to a bank account. No savings account, no credit, no way to store value securely. No way to send money internationally without paying fees that eat 30% of the transaction.
In 2024, if you want to send money from the United States to the Philippines, something millions of families do every single month, you're paying fees of anywhere from 5 to 15%, and it takes 3 to 5 business days. In the 21st century, with all our technology, 3 to 5 business days. Banks had 100 years to solve this problem. 100 years of global infrastructure, international agreements, SWIFT networks, wire transfers, and the best they came up with was 3 to 5 business days and a 15% fee. Stellar Networks settled a cross-border transaction in 5 seconds last year. Fee? Less than a fraction of a cent. Now, here's the historical parallel that's going to blow your mind. In the 1950s, the biggest revolution in banking wasn't stocks, it wasn't savings accounts, it was the credit card.
Before the credit card, if you wanted to buy something you didn't have cash for, you either needed a loan, which required collateral, a credit history, and a bank manager who personally knew you, or you didn't buy it. Access to credit was a privilege of the wealthy. The credit card democratized credit. Suddenly, ordinary people could make purchases, build credit histories, access financial tools that were previously reserved for the upper class. It still took 40 years for credit cards to reach global adoption. 40 years. DeFi, decentralized finance, is doing the same thing right now, and it's doing it without requiring you to prove your identity, without requiring a credit score, without requiring you to live in a country with stable financial infrastructure. Anyone with a smartphone and an internet connection can now access lending protocols, savings instruments, trading platforms, and yield-generating products that were previously available only to institutional investors with millions of dollars. Aave, Compound, Uniswap, these are not just crypto platforms. These are the credit card of the 21st century. And most people are still asking, but is it safe? Instead of asking, how do I use this before everyone else figures it out? The people who got credit cards in 1960 thought they were taking a risk. The people who are using DeFi protocols today think the same thing. History has a very clear answer about who was right.
Section 3. The institutional moment everyone missed. Let me ask you something personal. Do you remember the first time you heard the word Bitcoin? Most people do. And most people remember exactly what they thought when they heard it. That's weird, or that's a scam, or my nephew keeps talking about this and I don't understand it. Now here's the question. What did Goldman Sachs think when they first heard about Bitcoin? They thought the same thing. In 2017, Goldman Sachs CEO Lloyd Blankfein said he was not a Bitcoin fan. Jamie Dimon, CEO of JP Morgan, called Bitcoin a fraud in 2017 and said he'd fire anyone at his company who traded it. Fast forward to 2024. JP Morgan is now one of the largest holders of Bitcoin ETF shares in the United States. Goldman Sachs has a crypto trading desk. BlackRock, the largest asset manager on the planet, managing over $10 trillion, launched a Bitcoin ETF that became the fastest growing ETF in the history of financial markets. It hit $10 billion in assets under management in less than 2 months. Let that sink in. The fastest growing ETF in financial history. Faster than GAID ETFs, faster than tech ETFs, faster than anything that has ever been created before. Now here's the historical parallel. In the 1970s, when stock markets started gaining mainstream credibility, there was a critical moment. It was the moment institutional investors, pension funds, insurance companies, university endowments, started allocating to equities. Before that moment, stocks were considered speculative, gambling, only for people who could afford to lose.
The moment institutions entered, the game changed permanently. Not because institutions made stocks legitimate, but because institutions brought the capital that made the infrastructure viable. And with viable infrastructure came public trust. And with public trust came retail adoption. And with retail adoption came the generational wealth-building machine that the stock market became for the second half of the 20th century. We just hit that moment in crypto. January 2024, the Bitcoin ETF approval. That was our 1970s institutional moment. And just like in the 1970s, most people watching it happen right now have absolutely no idea what they're witnessing. The institutions aren't buying Bitcoin because they suddenly believe in decentralization. They're buying it because the math works, because their clients are demanding exposure, because sitting on the sideline while BlackRock captures $10 billion in 2 months is career-ending for any fund manager. And here's the thing about institutional capital. Once it flows in, it doesn't flow back out. Pension funds don't panic sell. University endowments don't check crypto Twitter. The capital that came in with the Bitcoin ETF is patient, long-term, and structural. The banking system took 50 years to get institutional legitimacy. Crypto got it in 15.
Section 4. The infrastructure revolution nobody is talking about. I want you to think about something for a second. You use your debit card. You tap your phone on a payment terminal. Money moves from your account to a merchant's account. It feels instant. It feels seamless. It feels like technology. What's actually happening behind the scenes is a system of ledgers, clearinghouses, correspondent banks, and settlement protocols that was literally designed in the 1970s. The ACH network, the system that processes most bank transfers in the United States, was established in 1972. The core infrastructure of modern banking is older than the internet. When you send a wire transfer, it goes through a system called SWIFT, the Society for Worldwide Interbank Financial Telecommunication, that was founded in 1973. 50 years old, and it is still the backbone of international finance. Here's why that matters. Legacy infrastructure is slow because it was designed for a different era. It was designed when computation was expensive, when communication was slow, when the assumption was that every transaction needed multiple human intermediaries to verify and validate. Blockchain doesn't need intermediaries. That's not a feature. That's a fundamental redesign of how financial infrastructure works. Think about what Visa can do. Visa's network can process about 24,000 transactions per second. That's actually impressive. It took decades to build. Ethereum, after its upgrade to proof of stake, is building toward processing hundreds of thousands of transactions per second through layer 2 solutions. Solana is already processing tens of thousands of transactions per second. And unlike Visa, these networks don't have business hours. They don't close on weekends. They don't take federal holidays off. And the really important thing, the thing that should make every banker in the world uncomfortable, is that these blockchain networks are programmable. Not just fast, programmable. That means the financial instrument itself can contain the rules of its own execution. A smart contract on Ethereum doesn't just move money. It moves money when specific conditions are met, automatically, without requiring a lawyer, a bank manager, or a notary. The contract executes itself. Think about what that means for mortgages, for insurance payouts, for international trade finance, for stock settlement, for literally every financial product that currently requires teams of people to verify, validate, and execute. JP Morgan's internal blockchain, Onyx, is already settling billions of dollars in repo transactions every single day using this technology. The European Central Bank is running pilots on a digital euro using distributed ledger technology. The Bank for International Settlements, which is essentially the central bank for central banks, published a report in 2023 calling blockchain-based financial infrastructure the future of the global monetary system. These aren't crypto enthusiasts saying this. These are the most conservative financial institutions on Earth. The banking system built its infrastructure over 100 years, layer by layer, adding new technology on top of old foundations like geological sediment. Crypto is building a clean sheet infrastructure that is faster, cheaper, more transparent, and more programmable than anything that exists in traditional finance. And it's doing it in a decade. Section 5. The currency moment, and why it's bigger than anyone realizes. Let's talk about the thing that actually changed everything. The thing that made the banking system what it is today. The thing that's happening in crypto right now, and almost nobody is connecting the dots. In 1971,
Richard Nixon ended the gold standard. The United States dollar was no longer backed by physical gold. It became, in financial terms, a fiat currency, backed by nothing but the full faith and credit of the United States government. Most economists at the time thought this was catastrophic. If money isn't backed by something real, how can it have value? But here's what happened. The dollar didn't collapse. It actually became more powerful. Because it was no longer constrained by the physical supply of gold, it could expand to meet the needs of a growing global economy. And because the entire world was using dollars for international trade, particularly oil, the dollar became the global reserve currency, the most powerful financial instrument in human history. Now here's the crypto parallel that should make your hair stand up. Stablecoins. Right now, the total market cap of stablecoins, cryptocurrencies pegged to the value of the US dollar, is over $150 billion. USDT, USDC, DAI, these digital dollars flow freely across blockchain networks, settling in seconds, available 24 hours a day, 7 days a week, globally, without restriction. And here's the thing that traditional finance has not fully reckoned with yet. Stablecoins are not just a crypto tool. They are digitizing the dollar itself. They are making the US dollar programmable, borderless, and instant. The United States Congress is currently debating stablecoin legislation, not to ban stablecoins, to regulate and legitimize them. Because American financial policymakers understand something extraordinary. Stablecoins are extending dollar dominance into the digital age.
A farmer in Nigeria doesn't want to hold the Nigerian naira. The naira loses value constantly to inflation. But that farmer can now hold USDC on their phone. They can earn yield on their USDC through DeFi protocols. They can use their USDC to buy goods internationally without going through a currency exchange. They are effectively dollarized, without a bank, without a correspondent banking relationship, without any of the traditional infrastructure that would normally make this impossible. The dollar's dominance in the 20th century was built on oil contracts and SWIFT wires. The dollar's dominance in the 21st century is being built on stablecoins and blockchain rails. And this is happening right now, in real time, at a speed that the banking system has never seen before. But here's where it gets even more interesting. Because while dollar-backed stablecoins are extending traditional monetary power, Bitcoin is doing something completely different, something that has no historical precedent in banking history. Bitcoin is creating a monetary system that isn't controlled by any government at all. There will only ever be 21 million Bitcoin. That's not a policy decision. That's mathematics. No politician can change it. No central bank can inflate it away. No government can freeze it. No institution can confiscate it without your private key. We've never had this before in the entire history of money. We've had gold, but gold can be confiscated. Governments did it in 1933 in the United States. We've had fiat currency, but fiat can be inflated. Every fiat currency in history has eventually gone to zero. Bitcoin is something genuinely new, and it took us 10,000 years of human civilization to invent it. The banking system, for all its sophistication, is built on trust in institutions, trust in governments, trust in the people managing the system. Bitcoin requires no trust. It requires only mathematics. That is a more fundamental shift in the nature of money than anything that has happened since the invention of coinage in ancient Lydia around 600 BC. And we're watching it happen in a decade. So let's bring this all together. Because I started this video with a statement that crypto is doing in 10 years what banks did in 100. And I want to make sure that by the time you close this tab, you understand exactly why that's not hyperbole, that's history rhyming in real time. Point 1. Trust. Banks spent the first 30 years of the 20th century failing repeatedly. Bank runs, collapses, the Great Depression, before the regulatory infrastructure that created mass trust was established. Crypto is going through the same crucible. The collapses of FTX and Celsius are not the end of crypto. They are the painful, necessary birth of better systems. Proof of reserves, on-chain transparency, regulatory clarity.
This is crypto building its FDIC moment. Point 2. Access. Banks took 50 years to create the credit card, the tool that democratized financial access. DeFi is creating the same democratization in real time for 1.4 billion unbanked people, for anyone with a smartphone and an internet connection, without requiring permission from any institution or government. Point 3. Institutional adoption. The moment that transformed stock markets from speculation to legitimacy was when pension funds and endowments entered in the 1970s. Crypto hit that moment in January 2024 with the Bitcoin ETF approval. But capital is now flowing in from the most powerful financial institutions on Earth. That process does not reverse. Point 4. Infrastructure. Banking infrastructure was built over a century on systems that are now 50 years old and creaking under the weight of the modern economy. Blockchain infrastructure is being built from scratch, faster, cheaper, more transparent, and more programmable than anything traditional finance has ever created. And the most conservative institutions in the world are building on it.
Point 5. Currency evolution. The end of the gold standard in 1971 created the modern dollar-based global economy. Stablecoins are creating the digital dollar-based global economy. And Bitcoin is creating something entirely without precedent, a mathematically scarce, politically neutral, globally accessible store of value that requires trust in no one. Now, here's what I want you to take away from this video, and I want you to hear this clearly. This is not about getting rich overnight. This is not about trading meme coins or chasing the next 100x altcoin. This is about understanding that we are living through a once-in-a-generation shift in how money works. A shift as significant as the invention of paper money, as significant as the creation of central banks, as significant as the establishment of the Bretton Woods system after World War II. The people who understood those shifts when they were happening, the people who saw the pattern before everyone else, those are the people whose names are in history books. The people who laughed at them are footnotes. You have the opportunity right now, right in this moment, to see the pattern. Not to gamble, not to speculate wildly, but to understand, to educate yourself, to make informed decisions about how this technology fits into your financial life. Because here's the hard truth. The window doesn't stay open forever. The institutions are already in. The infrastructure is already being built. The regulatory frameworks are already being written. The people who wait until crypto is mainstream enough to feel safe are the same people who waited until Amazon stock was at $500 to decide the internet was real. The question is not whether this transformation is happening. The question is which side of it you want to be on. And look, I'm not here to tell you to put your life savings into any particular coin. I'm not here to give you financial advice. What I am here to do is give you context, pattern recognition, historical perspective.
Because if you understand what happened with banking over 100 years, and you can see the same patterns accelerating in crypto over a single decade, then you can make your own informed decisions. You can do your own research. You can understand the difference between speculation and structural transformation. And that understanding, that is more valuable than any price prediction I could ever give you. If this video gave you a new way of seeing what's happening in the crypto space right now, then do me one thing. Not for me, for yourself. Hit that subscribe button. Because this channel exists to give you exactly this kind of content. Historical context, pattern recognition, clear, honest analysis of where the money is actually moving and why. We cover everything from Bitcoin's macro role in the global economy to the DeFi protocols that are quietly building the financial infrastructure of the next decade. We don't hype, we don't shill, we decode. And if you want to go deeper on any of the points we covered today, whether that's the Bitcoin ETF analysis, the stablecoin legislation, or the DeFi protocols that are actually worth understanding, let me know in the comments. Drop the topic you want me to cover next. I read every single comment. The financial revolution is happening. The only question is whether you're watching from the sidelines or whether you're educated enough to understand what you're watching. I'll see you in the next one.